Thank you for joining us on this Thursday for the September installment of the Tarrant Financial Partner Webinar Series. I believe this will be the fifth webinar series. Today we'll be discussing the Alpha Capital portfolios that we use in our portfolios and as well as an update where we are and where we think we're headed. If a question comes to mind during the presentation, please feel free to pop that in the chat box, or you can hold this till the end and we may have some time to unmute and ask questions. But with that, I'll turn it over to Mike Tarrant.
Charlie, thank you very much. Everyone, welcome to the lunch hour here on a beautiful September afternoon. Hope everyone who's in the area is enjoying this fall weather. We're really enjoying this quite a bit. Before we tee up Brad to get into the portfolio, I just want to give everyone a little bit of an overview of our investment philosophy and kind of how Brad's company, Alpha Capital, ties into that. So just as a recap, you should see on your screen. As most everyone knows, we focus on asset allocation-based portfolios that are tied to a financial plan. We believe that beginning with the financial plan is where a good investment plan begins. So we typically start there. We like to allocate between short-term, mid-term, and long-term buckets so that you have a good cash reserve in place, that you've got mid-term type money for something down the road, 2 to 5 years out. And of course, long-term money invested primarily in equities to help outpace taxes and inflation. You've probably noticed we tend to prefer equities over bonds for the long term. That doesn't mean we do not hold bonds at all. Just means we will tend to tilt a little more toward equities than many other advisors may do, because we are aware of longevity, life expectancies, and planning on a typically two-person 30-year retirement means that 1/3 of someone's life can be spent in retirement. So we want to ensure that their portfolio helps outpace taxes and inflation to keep up with rising living costs down the road. You'll see that fourth bullet point there of co-managed portfolios with strategic partners. This is where Brad's company fits in with Tarrant Financial. We basically work with professionals such as him to help build our portfolios of mutual funds and ETFs and separately managed accounts so that we can maintain the focus on financial planning and have a partnership with investment experts who help us build the portfolios and oversee the structure of those portfolios for us. You will not see a lot of trading in the portfolio. We typically buy and hold within our portfolios to let the managers do their work through different economic cycles. We will periodically rebalance, though, if allocations are a little more out of balance with our targets. Obviously, aiming to keep expenses low. Pay attention to the taxes when advisable. You probably heard me say we won't let the tax tail wag the dog, so to speak. However, we do want to pay attention to taxes and take advantage of those breaks when we can. For certain clients who have a lower probability of long-term wealth, we may utilize an annuity to help provide some protected income there. Just depends on how successful their financial plan projects out to be. And then we do encourage clients to build up both their retirement and non-retirement accounts so that they can experience tax diversification in retirement. So that's the Tarrant Financial investment philosophy. And we do like to maintain a risk assessment for our clients as well, and run a portfolio through our risk assessment tools to help set expectations of portfolio behavior in various markets, set up some guardrail expectations. So over a given 6 to 12 month period, you could expect your portfolio to be up or down by a certain amount. Of course, this is a sample on the screen. But we want our clients to be educated about what they should expect in their portfolios. So that's what I wanted to bring to bear today. So with that, I'm going to release the screen share for a moment and introduce our guest speaker, Brad Alford. So Brad founded Alpha Capital Management in July of 2006. He has over 34 years of investment management experience and directs the firm's outsourced chief investment officer and consulting search services, which designs and runs investment, consulting, and OCIO searches for institutions. Brad has recently helped create the Alpha NASDAQ OCIO indices to advance transparency in that market, partnering with NASDAQ in their development and launch back in 2019. He has also launched the Alpha Peer Universes, giving clients an online tool to compare performance and asset allocation of over 1,200 different institutions, partnering with Evestnet, FactSet, and Solovis for integration into their platforms. Prior to founding Alpha, Brad has served as managing director at Atlantic Trust, director of investment advisory services at My CFO, managing director of the investment division of the Duke Endowment, and Director of Endowment Investments for the Emory University Endowment. And he has also created and sold IPOlookup.com way back in 1999, 2000. One of our favorite Alabama grads, even though as Georgia fans, we tolerate that relationship, right, Brad? Exactly. He holds a BS in corporate finance and an MBA from the University of Alabama. He's completed the intensive senior investment management program at Princeton University. Currently is a CFA, Chartered Financial Analyst charter holder, and member of the CFA Institute and the CFA Society of Atlanta, serving on the finance and investment committees of Marist School and the Atlanta Ronald McDonald House Charities. In our relationship with Brad, Alpha Capital consults with us about portfolio construction, asset allocation, and mutual fund and ETF management and research. Our partnership has led to implementation of the Tarrant Financial Alpha portfolios designed to bring risk-aware, smoother experience for our long-term investors. So with that, Brad, we will turn that over to you.
Great. Thank you, Mike. Thanks, Charlie, and thanks everyone for getting going early this morning and hearing about how we manage portfolios. As Mike said, my background, I need to let my wife listen to that background. It sounds impressive, but I've been in the business for a long time. I was fortunate enough to start my career here in Atlanta. So we're located in Atlanta, and I'm at our headquarters. And I started at Emory University's endowment back in 1989, a long time ago, and then left and went to the Duke Endowment in 1995 and stayed at those two institutions for over a decade and really learned how to manage money on an institutional level, broadly diversified, multiple asset classes, and try to keep fees as low as possible. So I'm going to walk you through how that philosophy and really that early upbringing with these two institutions has instilled the way we had our process here at Alpha and how we work with Mike and his team. I'm going to pull up these slides real quick and not go through every one of them, but I am going to hit the highlights on a couple really into the portfolio. So you can see the overview of Alpha Capital, I hope. Is that right, Mike?
Right.
Okay, good. And so, we're an independent firm. The only person we answer to are our clients, like, Mike and his team. We try to find the best investment managers and really an institutional type of a focus. Believe it or not, even big pools of money like Duke and Emory use mutual funds and ETFs. Not everything's in a separate account. They do that as well, but a lot of really great managers also run mutual funds, and ETFs are primarily a more of an indexing strategy. So we supplement different areas of a portfolio with low-cost ETFs. So I did talk about my business partner Anna. So Anna's out this week on vacation, or she would be on this. And so we've been working together for about 11 years. She joined me. I launched Alpha 16 years ago, and she joined me 11 years ago. And I went to, as Mike was nice to say, I'm a Bama grad. Anna's a lot smarter than me. She went to Princeton, and then she worked at two of the leading consulting firms in the world, but Mercer, which is the largest institutional consulting firm, working with very large plans and pools of money, and managing portfolios the same as we did at Duke and Emory, and Rogers Casey's as well. So, we're both very knowledgeable in managing money. I'm a lot older than she is, but she is, fantastic right-hand person. We're both CFAs, which is a 3-year designation that is a very intensive process. They offer the exam roughly once a year, and it's got about a 50-50 pass failure rate. So it's kind of like getting a master's in investment. So we both have committed ourselves to this industry. What I want to talk about now is really how we build portfolios. And this is one of my favorite charts called the quilt chart. And this shows you for the last 20 years, which asset class performed the best. And so the reason it's called the quilt chart, because there's no consistency. Colors are everywhere. And it's really hard to figure out what's going to work on the far right. What's going to happen we've got 630 numbers in here. What's going to happen in 2024 and beyond. So one of the things I did is I colored the S&P red. You see it kind of bounces around, and then bonds are yellow. So, it's very easy to say when bonds are at the top, that means things are not going very well. And so, 2018, 2011, 2008, were very rough years. But what you will see is this red has been near the top half almost all the time. So you want to stay, you're going to have bumps in the road, but you also want to stay in the equity market and try to, handle those bumps. One thing very unique about 2022, which everything was red, was, the yellow, which is typically the safest spot, was not the safest spots. Actually, big value stocks, stocks have big dividends and are considered, and good earnings more than like a growth stock, like a technology stock, did better than bonds. It was a very unique year last year. So, what we've seen so far, first 6 months of this year, is things are getting better. It doesn't feel better because we're talking about what the Fed decided yesterday. Still some rate hikes are in our future, but things have gotten better. If you look at this S&P number up 16.9, historically the S&P over the last 100 years has been about 9%. So 16.9 is almost double what a historical average would be. So, we're seeing some bumpiness here. September has typically been, August and September has been some corrections in those months. We're seeing that kind of flowing through in August, and September is not off to a great start, even though we're well, 21 days into it. It's been very volatile and negative so far. So we're giving some back since 6:30, which is not expected. If you look at an average, the outliers, the fat tails, there will be some reversion back to that, more average number, kind of 8 to 9. Given last year's down 18, we've almost made it back this year. So that's been nice to see. I'm going to keep going about the portfolio, and as we said, Mike and his team run these 6 risk-based portfolios, and hopefully not get too basic, but the 80-20 would be 80% in equity and 20% in fixed income and kind of risk mitigating assets. So on the far left would be your most aggressive portfolio, and the far right would be the most conservative portfolio. So just talking about the positioning, as I said, there's areas of the portfolio where hiring stock pickers, equity managers that, if you think you can beat their index, is very hard in the large cap. I mean, even when I was at Duke in the 90s, we were indexing or going passive in large cap. So, we're going to be active where we think that the manager can actually, they earn their fees. They can actually beat an index. So here, we're just using a very inexpensive index fund, Fidelity's index fund. And then also in large cap, we want to have some kind of unique plays as well, rather than just indexing. One thing about the S&P 500 right now is very heavily weighted in technology. Microsoft, NVIDIA, Google, Facebook. I mean, the S&P is starting to look like a technology index, and so we also want to do some things in that. We want the biggest percentage of the portfolio to be in large cap, the biggest and safest areas. Companies that can handle a rough kind of economy that we're going through right now. But we also want to have some different bets on within the large cap area, especially given how the S&P is so technology weighted. So Dividends Aristocrat is an ETF, really interesting strategy. So it's like an index strategy. It takes the S&P 500, just those 500 stocks, and will only invest with companies that have dividends, and they've also increased their dividends for the last 20 years consecutively. So if you can only imagine, first, the company's got to be at least 20 years old, and they've got to also be raising dividends. So it's more of a quality play. These are companies that are growing, their dividends are growing, and their earnings are growing. And so that has about 60 names. So if you look at the S&P 500, only about 10% of the name, 12% of the names or companies in that qualify to be in here. So, big safe companies like a Walmart, a Coca-Cola, things like that are in this ETF. Federated Value Dividend is classifying the stocks with the biggest dividends. I mean, one of the good things right now is dividends are quite a bit higher, especially in higher interest rate environments. And so if the stocks can just stay stable, then they're paying dividends of roughly maybe 4 to 5%. And you get a better tax treatment on the dividends than the current income. And so This is a very, very safe portfolio, which was implemented last year to really add some more downside protection to the portfolio. And mid and small cap, we still want to find those stocks that may be the next Microsoft or something like that, or maybe a Walmart or whatever it's going to grow up to be in large cap. Every small cap and mid cap wants to grow up and be a large cap, meaning they're one of the 500 largest companies in the U.S. And so we have two. We really believe that you can add value here. We've got two really good managers that manage these two portfolios. They're both stock pickers. We don't have a pure growth play. We have one core manager, the Virtus Midcap, and so they're trying to find also companies that are both growth and value, a blend of those two, and put them in this portfolio. And then we've got Crawford Small Cap, and it looks a lot like Dividend Aristocrats. It looks at the S&P, the small cap companies that are $1 billion smaller, and they also have rising dividends. So it's a rising dividend strategy. And so, a lot of the technology companies don't even pay a dividend. So doesn't have this big technology weighting that you see a lot in small cap. International, we're using a really interesting fund by MFS where it's got 5 different funds inside of it run by MFS. So a large cap, a mid cap, a small cap, an emerging markets fund, and then one value strategy. And so it's actually has a variety of different portfolio managers within it. So it's not just one or a small team picking stocks. It's a whole pool of different managers picking stocks all over the world. We still think there's some great companies outside the US, but you will see, just this one weighting is only 18% compared to 18% we have just in the S&P 500. We're a real believer that some great companies in the US. You don't have to worry about geopolitical risk, currency risk, and things like that. So you don't want to completely give up on non-US, but you still want to have that home country bias, especially the US being the best economy in the world, and obviously the safest economy. We tried some things in the past, emerging markets, dedicated emerging markets play. If you look what's going on in China right now, it's a mess. And so you just don't want that type of risk in your portfolio. And so that's really the stock portfolio. And what I had also talked about was building a portfolio of institutions, not just stocks and bonds, not just a two-trick pony, but also having other things in your portfolio besides the stocks and bonds. And so we have, utility stocks in here as well that pay their, utilities pay a good dividend. Utilities are regulated. They can raise prices if their underlying costs get higher. And so that's another big safe play. They have as I said, a good dividend, which certainly helps. And then we have an infrastructure fund. And so this fund, we've had it in since, we started working with Mike and his team over 7 years ago. And that is really infrastructure stocks all over the world that are publicly traded. So toll bridges, airports, things that are, no matter what the economy is doing, going to work. It's been probably our best fund we've ever had with consistent returns, very low volatility. They take all the non-US stocks and hedge them back to the US dollar, so you don't have any currency risk. So it's a really interesting fund. We will make changes in the portfolio. We make typically, and I'm sure you've seen them, 2 to 3 a year. We don't try to time the market or anything like that. We try to go through market cycles, pick great managers and ride with them. But Lazard has been in here since day one. Been a really, really fantastic investment. And then on the fixed income side, we want to have a variety of different fixed income plays. We have tips, which are really for inflation, which obviously we're continuing to see. We'll talk a little bit about potential recession, but inflation has not slowed down. I'm sure you see that when you're buying things and the prices. I know I do. I've got 3 kids, and grocery bills and things are just still very high. 2 fixed income managers, MetWest is in California, one of the better fixed income managers for the institutions use. They buy fixed income all over the world, mainly in the U.S., but have a small, maybe 5 to 10% outside the U.S. Double On is a guy named Jeffrey Gunlock. He's one of the more famous bond investors. He buys a lot of residential mortgage-backed securities. So, right now, house prices and interest rates rising, people are not refinancing their houses because interest rates haven't dropped. That's when we typically refinance. So these are great investments during rising interest rates. And then we have Oscar Wise, which is another manager in California, and they've been in the portfolio since day one. They buy very short-term high yield and roll it. So it's been another fantastic investment for us. And as I said, we don't hire and fire managers, monthly, quarterly. We really try to find great managers to stay with them. We know sometimes that they'll have rough patches, but we hire them because they're smart, and we know they are smart, even though that sometimes their investments maybe on the wrong side at the time. So that's the portfolio. As I said, that as you go across Mike and team figure out your risk metrics, and then they figure out which portfolio you fit in. But you get all the same managers except for this 100% equity. Obviously, you wouldn't have any fixed income exposure. So another thing about having a portfolio that's broad diversified is diversification means you always have to say you're sorry. Something's not going to be working. If you just have an equity portfolio, a one-trick pony, then sometimes everything's great, but other times you're in panic mode, especially last year. And we'll talk a little bit about what happened last year. But we want things that can handle a bumpy ride. We've had a great since 2008. My kids don't even remember what 2008 was like, but it was awful for everyone out there, and we all know about that. And we had pretty smooth sailing for quite some time until last year. So we're going through a bumpy patch, and so we're very happy to have. We're not unhappy to say we're sorry, because diversification, especially last year, really paid off. Finally, one of the scarier things is that inverted yield curve has always been, there are very few guarantees in life. But this chart shows you that an inverted yield curve has always been the sign that we're going to have a recession. So a lot of people are saying the recession's off the table. We have seen that happen in the past, 100% of the time. And so we are a little concerned that we will see a recession, but this next 6 months is going to be very telling about which way the economy is headed. So that's all the prepared remarks. I know I got into the portfolio. I love talking about managers. The big picture. What I've learned in the last 30 years is very hard to time the market. What you want to do is be with great managers, very broadly diversified portfolio, and try to be able to, sleep at night portfolio. This is your personal savings, and you don't want to, you work so hard for it, and you don't want to just lose it because, you're taking on too much risk. So, thank you for working with Mike and his team, and I'd love to take questions now.
Yeah, Brad, thank you very much for the update there. And anyone has a question, just drop it in your chat, or you can unmute and speak up. We're a small crowd here today, which is great. But while everybody's preparing their questions, Brad, I'll run a couple by you. You brought up a little bit about the dislocation last year in 2022, which really, when we look back over time, I believe the last time I've seen in recent memory of a dislocation between stocks and bonds was probably in the 1970s, where you had a year or two where all of it went down. So, I remember back in 2008, government bonds were actually positive when everything else was not working. But last year, not even government bonds were positive. So I guess my question is, looking back through last year's dislocation with bonds down about 13%, how did that impact the alpha portfolios, and kind of what is your outlook for the 4 bond funds going forward?
Yeah, and trying to think, in the 70s, Mike, I was with you. I was probably on a playground somewhere, so I don't quite remember it as well. But excuse me. Last year was, running a portfolio for 30 years was the first time I've really seen bonds take a very hard hit and not be, this safest part of the portfolio. We were fortunate enough to other things. As said, they as one client told me a long time ago, I don't care about relative performance. I care about absolute performance. Did I lose money or not? I don't care about how I did versus an index. But we had some managers that were flat or close to it. I mean, last year was a very rough year. The S&P down almost 18, and then bonds. Historically, bonds earned 5 to 6% a year, and they were down 13. So it was a very asymmetric event. And so, bond funds last year, we tried to keep get on the shorter end of the curve. We added that TIPS exposure. We have not taken it off. That Treasury inflation protected securities is what I talked about, to try to do well in an inflationary environment. I mean, the good thing about bonds right now is they've really stabilized. They off to a great start at the beginning of the year when they thought the Fed would not continue to increase rates. The Fed announced yesterday there's at least one more rate hike. They're really trying to do anything to stop a recession. So right now, the fixed income are earning kind of 5 to 6%. It's back to normal, and so one more rate hike shouldn't really hurt bonds. It could hurt equities, because these companies are paying higher interest rates. I'm sure everyone knows that a money market account now is paying 4+%, which I haven't seen in a very long term. Money market accounts used to pay 1 basis point just so they would pay something, and now for them, where cash is not trash, is quite unique. And so that would be another concern, is that corporations have to pay higher interest rates. That really hurts their profits. And so I would be less concerned about bonds and really more concerned about equities right now.
Understood. Yeah, I was going to ask you if you feel like we're set up for another bond bull market, since we just came off of a 30-year one there. It sounds like from what you're saying, we may need to be a little more patient for the next 6 to 12 months in the bond market.
Yeah, I don't have a crystal ball for sure. I learned that a long time ago too. But it was so interesting. The Fed kept telling us they're going to raise rates and saying it, and everyone still held bonds, because it felt like no one to buy equities. And now the Fed is telegraphing that they're going to do one more rate hike, and they were going to possibly cut it twice next year. But I don't think there'll be a bond rally starting, but I think there's bond stabilization is really where you just earn that 5 or 6% a year, and you want to have these bond funds moving around, the way they were last year, or in that bull market where they earn double digits. When bond markets start earning equity-like returns, that's actually time to be cautionary.
Right. But before I pivot back to your equity comment, just one last question on the bond portfolio. With interest rates so much higher now than they were last year, what have the bond fund managers done to take advantage of that or to protect the portfolios?
It's interesting. All of these managers manage towards an index, and so I thought, whether it's an equity manager when I was young and naive, and I'm probably still naive to some extent, but not as young, that these managers would go to cash, and on the bond side, really shorten their average maturity or duration without getting too technical. And they tend to focus on, they're judged versus an index. They get paid more by whoever, they run money for if they beat this index. And so they're not going to make huge bets. So, go plus or minus maybe a year from the duration of their index on the fixed income side. And so they did shorten it up a little bit, but they certainly didn't just, sell all their medium and long-term fixed income and then, put it all in cash. So they're not going to take that career risk themselves, because just timing the market is a complete loser's game. And so right. they are going to manage towards, some type of an index. So you just got to make sure the portfolio you're in, what index that it's being judged, and that's the type of portfolio you're going to get.
From what we could tell, they've really, as bonds have matured and they bought new issues, it seems like the yields are trickling in the upward direction in the bond funds. So that's what we're observing anyway on our data.
No doubt. I mean, earning 5 to 6% fixed income is finally kind of a good thing. I mean, it doesn't help all that really cheap money help these corporations really leverage their balance sheet on the equity side. Mm-hmm. But now they've got to kind of pay the piper a little bit for having all this debt, so it's not helping them as much. But having fixed income that's safe. I mean, the Fed hasn't telegraphing that it's going to move rates up again 10, 11, times in a year. They said maybe one more, and then we'll start cutting again. So it feels not as safe as maybe 6 months from now, and they're all like, we're done raising rates. But it feels feels a lot safer than it did
Right.
this time last year.
So I know we're running up on our time limit here of 8:40, but since we started about 5 minutes late, if everyone's good for hanging around for another 5 minutes, we'll go to 8:45 because I do have a couple more questions for you, Brad. Kind of pivoting over toward the equities for a moment there. You expressed some caution going forward, with a little more caution with equities than with bonds. So maybe walk everyone through a little bit more about what you mean by taking caution in the equity portfolio, how our portfolio is currently built for that, and if you anticipate any pivots down the road.
Yeah, and we run a more conservative portfolio in any environment. We're not going to chase technology. There's 5 or 6 companies, and they're now heavily in S&P. The Microsofts of the world, the Googles of the world, the Facebooks, Apple. We're not going to chase that. We're getting that exposure in our S&P positioning with the Fidelity Fund. We're just indexing. We own those names. It is amazing that the top 10 names, I think 7 of them are technology companies. I mean, Amazon, whether you say it's a technology company or not, a lot of people still consider it more of a technology play. And so we are trying to add buffers in there that will handle, especially this big run up. We're not going to keep up with this, tech-driven market we're in right now, but we're also not going to participate as much on the downside. So we have high dividend managers in there, like Federated. We have rising dividend managers in there, like this Dividends Aristocrat, that Noble is the ticker, as well as the Crawford Rising Dividend Fund. And so, what we want to do is hit singles and doubles. We are not going to try to hit a home run. If you want to hit a home run, go, buy a technology fund on your own. That's going to be very volatile. And if you've got a 5 or 10 year horizon, maybe 15, then it probably be a great investment. Maybe not now, given how much they've run up, but we're trying to do what we did at Duke and Emory endowments, where you just try to earn kind of 7 or 8% a year in total return, and not have the big downswings where you're down high double digits or something like that. So we've got it positioned very, not as conservative as we have in the past, but pretty conservatively and very broadly diversified across the world.
Yeah, to your point, Brad, I think we've been positioned that way now for coming up on about 2 years, where we kind of gravitated, or I should say tilted a little more toward value, definitely tilted more toward dividend payers, knowing that the cash flows have to be consistent to make those dividends, which would indicate corporate strength within the portfolio. So far we've been pretty pleased with that. And just so everyone knows, when Brad and I work on portfolios, at times they will come to us with recommendations, and at time we'll come to them with an idea. And we definitely partnered on that last year when we brought the Federated Strategic Value Dividend Fund into the portfolio, which has a much higher dividend focus. So just wanted everyone to know that it goes both ways in our partnership together there. Interestingly, we noted last year, what your diversification chart, which you called the quilt, I kind of called the twister board, because you're like, where do I put my foot next? Ironically, what was working really, really well for us last year has been a little bit of a lagger this year. And this is not a complaint, just more of an observation for clients, because we're trying, as you mentioned, we don't want everything going the same way at the same time, if at all possible. And this worked really, really well last year, in that utilities were up, infrastructure was up, the Federated Fund was up, while the S&P 500 was down 18%. So when clients needed money from their portfolio, we had places to go. This year, that seems to have kind of flipped a little bit, with the S&P kind of leading the way, and the other three, down slightly, about 5 or 6%. So do you kind of see that pivoting at some point, or are we kind of in a holding pattern now for maybe the rest of the year?
Yeah, I would definitely say in a holding pattern. The equity market looks pretty fully valued. It's a lot of pretty jittery market right now. Had about 6 weeks of downside volatility. As I said, the S&P, there's greed and fear. We were in a complete fear mode last year, and then the first 6 months of the year, it was complete greed. stocks like NVIDIA that are going to revolutionize the world with AI. They got to be $1 trillion companies. And
Right.
it just got a little crazy. And so, they became part of the top 10 of the S&P 500. People have never even heard of NVIDIA until this last year with AI. And so, we're a little concerned. I mean, I don't think there's going to be a big correction, but a little concerned that we should be, probably flat, very choppy the rest of the year. We have December coming around, Santa Claus rally, and hopefully some good stuff. But I would love to get through September and October, and not have a really big downdraft, and then have hopefully a November and December typically is a really good month as people are out spending money, buying gifts, things like that. So I'm just fingers crossed we can make it the next 6 weeks without a big downdraft.
Right. And I like to remind clients too. You kind of brought this to my mind here, Brad, for a second. That year to date, the S&P 500 is up about 17%. But looking back over the last 12 months, it's up 16%. So for those investors who did not sell out of the S&P back in the fourth quarter when it was down 18%, you're essentially back to where you were. So it definitely pays to wait, as you tried to indicate in the presentation today, on certain things and just tweak the allocations from time to time as well there. So definitely appreciate your help with us on that and your partnership there. We have a couple of minutes. If anyone has a question, feel free to unmute your mic and just jump in. All right, as they say in my church, hearing none. We appreciate everyone's attendance here today and participation. If you have any questions, please let us know about your investments or your portfolio or the strategies that we're implementing there. Brad, really thank you for your time. Thank you and Anna for your partnership and just helping us bring a smoother investment experience to our clients, a little more risk-aware portfolios. It's been a great partnership and we appreciate your work. Everyone have a great day. Enjoy this beautiful fall afternoon.